With the Fed continuing to dramatically increase the money supply and economies beginning to open back up after the pandemic, inflation could finally be coming our way. Cathie Wood from ARK Invest predicts we will see inflation doubling from the current 1.7% to almost 4% very soon. So the question is, what does this all mean? How does this impact our investments? And why should we even care about inflation? Well, as investors, obviously the more we know about what to do in times of inflation or deflation, the better we're going to become, and ultimately the more money we're going to be able to make. And the good news is that in times of inflation, there are certain investments that actually do very well. So this video is all things inflation, and we will be looking at the recent explosion in the M2 money supply, Cathie Wood's recent warning about inflation. We'll look at the investments that actually do well in times of inflation, and also the investments that tend to suffer. As always, if you do find anything useful in the video, be sure to drop a like, as that's always very much appreciated. Okay, so first up, Cathie Wood recently spoke out about the alarming increase in the M2 money supply. Let's take a look.
M2 is up 27%, so we've seen an acceleration. And this week, just listening to Chairman Powell, Chairman of the Fed, it seems like he's very focused on unemployment, the 10 million jobs still lost relative to pre-COVID.
So she talks about the recent big explosion in the M2 money supply. And for anyone who doesn't know, the money supply is measured by what's known as the M's. M0, M1, and M2. M0 is all the cash in circulation plus the central bank's reserves. M1 is everything that's in M0, but it also includes all the money in people's checking accounts. And M2 is the most common measure of the money supply. Take a look. So it's the M2 money supply that's one of the most watched indicators for money supply and future inflation. And it's a broader measure than M1, which just included all the cash in circulation and checking deposits. M2 also includes anything that's easily convertible into cash. So this includes money in saving deposits, money market funds, mutual funds, and other time deposits. And this is the M2 money supply that's taken from the Federal Reserve website. And this is a bit of a scary chart. So this goes back to the 1960s, and we're working in the billions of dollars. So this is 2 trillion, 4 trillion, 6 trillion, etc. And you'll notice it wasn't until 1984 that in the entire history of the dollar that we got to the $2 trillion mark. Now, it was just over 10 years that we got to 4 trillion. Then it was only 5 years to get to the next 2 trillion. Then 4 years to get to the next 2 trillion. Then only 1 year to get the next 2 trillion. The next 2 trillion just came within 6 months. And as you can see from 2020, this has been a 27% increase. So 27% of all the dollars created was only created in the last 1 year. Now, let's just cover one of the key misconceptions I see about inflation. Many people think that printing lots of money causes inflation, and this isn't strictly true. Think about it. As you saw, the Fed has just created trillions of dollars, yet inflation is around 1 to 2%. So this can't be true, right? And the reason is because money printing is only half of the equation. And to get big inflation, we need the other half. And this is velocity. And velocity is how much money is actually circulating around the economy. For example, if we all just sat at home stacking toilet paper and not actually spending anything, then money has a velocity of 0. Now, let's say we go out for a meal, and at the end of the meal, we tip the waiter. The waiter then uses this money to get a taxi home, and the taxi driver uses this money to get a takeaway at the end of his shift. Now, this time the money was spent 3 times, or a money velocity of 3. And so to get big inflation, you need money printing, but you also need people spending money and not saving. So what's going on with money velocity right now? Good question. Let's see. This is the velocity of the M2 money supply, again taken from the Federal Reserve website. Again, it goes back to 1960, and you can see it kind of hovered from this 1.6 to 1.8 ratio for quite a few decades. It began to pick up in the 1990s, leading up to the dot-com crash. We've then started to see this downward trend into the great financial crisis, and ever since then it has been dropping, but you can see it's the pandemic that is the opposite of the M2 money supply, and it's crashed down to these historically low levels. So from the Fed and the government's point of view, this is bad. They want you spending money. And why is this? It's because one person's spending is the other person's income. And when you have an income, you can tax it. And that is how the government makes money. Okay, so before we take a look at what Cathie Wood said about inflation, who's actually keeping track of all of this? Well, it's measured by the CPI, the Consumer Price Index. Take a look. So the CPI is a measure that examines the average price movements of a basket of consumer goods, and it actually tracks around 80,000 different items. And this falls into 8 major different consumer groups. We've got clothes, transportation, education, other goods, recreation, medical care, food and drink, and housing. And this is not to be confused with the PPI, which is the Producer Price Index. And this is basically the same thing. It tracks the price movements of products, but this time from the viewpoint of the business and not the consumer. Okay, so that was the CPI and the PPI. Now let's take a look at what Cathie Wood recently said about this coming inflation. Take a look.
We did get some inflation indicators this week, actually today. The PPI came out. It was much stronger than expected. It was up 1% month to month. This is not a year-over-year number, 1%. So annualized, that would be double digit, and that does sound scary. On a year-over-year basis, I believe we're at 4.2%. So we know that we're in the middle of what's called the base effect. Last year, we had declining prices as we entered the COVID crisis. And the declines lasted for several months. So now, year over year, we're going to be comparing against negative numbers. And so on the CPI, we believe, and we've been saying this for some time, that inflation will probably increase to the 3 to 4% range. It was 1.7% in February. And on the PPI, we'll probably see it accelerate on a year-over-year basis to the 6 to 8% range. Now, the Fed has said that it's expecting this. It's not going to react to it, and we believe them, especially given Chairman Powell's focus. And I think the markets are taking this quite calmly. Actually, maybe the anticipation of it caused the huge increase in the long-term Treasury yield from 0.9 at the beginning of the year to 1.75. Perhaps, but when I get into the fixed income markets a little later, we think there might have been something else behind that move.
So she believes the CPI will be going up from 1.7% up to 4%. So that's over double. And the PPI is going as high as 8%. So the question is, how does this impact our investments? Well, I thought it'd be useful to include a list of investments that tend to do well in times of inflation, and also the investments that tend to get negatively impacted. Check it out. So let's take a look at the investments that tend to do well and not so well in times of high inflation, starting with the not so good. First up, we have cash. In times of high inflation, cash is trash, as the purchasing power is beginning to get eroded away. Bonds. Anything that has a fixed income, as you're locking your money away for many, many years and it's fixed, this is bad because money is being eroded away. dividend stocks. So in general, the stock market does become more volatile. Now, I would say stocks still are a good investment, but anything that has a fixed income, like bonds or dividends, generally becomes out of favor. Now, what's good in times of inflation is good debt. So as the debt on your property is also fixed, it's also being eroded away. And this is why the government likes inflation too. Because the government has so much debt, they get to erode that debt away. You can also get inflation-protected bonds, and these rates will rise with inflation. Gold and silver are a very well-known hedge against inflation, as because you can't print gold and silver when there's more money buying the same amount, they tend to do very well. Which means the new kid on the block, Bitcoin, because of its limited supply, also acts the same as gold and silver. And this means this is probably really good for other cryptos too. And when it comes to stocks, because of inflation, people want a higher return, which means growth stocks tend to do a little bit better than dividend stocks. So if investors believe that big inflation is coming, we will begin to see outflows and inflows of the major asset classes. And this is one of the reasons why I think that crypto, stocks, and property are doing so well right now. Okay, to finish up, I have a bit of a bonus chart which I actually found very interesting too. It gives the big picture of inflation of the last 140 years. Check it out. So this chart goes all the way back to 1880. So a 140-year snapshot of the inflation rate in the US. And just look how volatile it was for the first 60 years. Back in the 1880s, it was negative 20% one year, only a few years later to be plus 20%, and such a volatile time to be living. But as you can see, as time goes on, it really starts to settle down. Now, in the last couple of generations, this is when you hear that inflation got a little bit out of control in the 70s and 80s. But ever since the turn of the century, apart from the blip in 2009 where it got a bit out of control, I would say that policymakers are starting to get control of the inflation rate. But I guess only time will tell. Okay, so bringing this all together, we saw the M2 money supply is exploding right now, but to get big inflation, we need the other half of the equation, which is money velocity. It's the CPI that's the main measure that tracks inflation, and this tracks the average price of around 80,000 products. Cathie Wood has recently warned that inflation is going to be doubling over the coming year, and historically, some proven inflation hedges include having good debt, as your debt will be eroded too, gold, silver, and Bitcoin, and other hard assets. Stocks do become more volatile, but in general they do pretty good, with growth stocks doing better than dividend. You can also diversify further with inflation protected bonds, and remember, in times of inflation, cash is trash. So keep your cash holdings quite low. So there you are, guys. Hope you found this video on all things inflation useful. In fact, just one favor to ask, if you did find anything useful in the video, be sure to drop a like. Only takes 2 seconds, and a big thank you to everyone who does. If you're not yet subscribed to the channel, I invite you to click below and join us. I do have some great videos coming up that you don't want to miss. Okay, cheers guys. Thanks for watching, and I'll see you in the next video. Bye for now.